What is short selling? Short selling is a strategy where you borrow shares of a stock, sell them at the current market price, and aim to buy them back at a lower price later. The goal is to profit from a decline in the stock price. Suppose you believe that the stock of XYZ Limited, which is currently trading at 1,000 Indian rupees per share, will decline in price. You borrow 100 shares of XYZ Limited from your broker. You sell the 100 shares on the market at 1,000 Indian rupees per share, receiving 100,000 Indian rupees. Over the next week, XYZ Limited's stock price drops to 800 Indian rupees per share. You buy back 100 shares at 800 Indian rupees each, costing you 80,000 Indian rupees. You return the 100 shares to the broker and keep the 20,000 Indian rupees difference as profit. To short sell, you need to open a margin account with your broker to borrow shares. Choose a stock that you believe will decrease in price. Research the stock's fundamentals, market trends, and use technical analysis to identify potential declines. Once you've identified a stock, borrow shares from your broker, which are typically borrowed from other investors who hold them in their margin accounts. After borrowing the shares, sell them on the market at the current price. This generates cash from the sale, but remember, you must buy back the shares later. Monitor the stock's price movement and wait for the price to fall so you can buy back the shares at a lower price. Once the stock has dropped to your desired level, buy back the same number of shares to return them to the broker. The difference between your selling and buying price is your profit. After buying back the shares, return them to the broker. If the stock price dropped as expected, you make a profit. If the stock price increased, you incur a loss. However, there are risks of short selling. There are unlimited losses. Unlike traditional investing, where the maximum loss is the amount invested, short selling has unlimited loss potential. If the stock price rises instead of falling, your losses can keep increasing. A short squeeze occurs when a stock's price unexpectedly rises, forcing many short sellers to buy back shares to limit their losses, which can cause the price to rise even more. If the stock price rises significantly, your broker may issue a margin call, requiring you to deposit additional funds to maintain the short position. Key points to remember include thorough research of the stock and market conditions before short selling, using risk management strategies like stop-loss orders to limit potential losses, and being aware that brokers may charge fees for borrowing shares, especially if the stock is hard to borrow. In conclusion, short selling can be a powerful tool to profit from a falling stock, but it comes with high risks, including unlimited losses. It's crucial to carefully research, use risk management strategies, and understand the market dynamics before engaging in short selling.